The following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And we have the answer about money. Here we're coming to you on The Answer, and we're talking about money. So have you ever heard of a company called 3G Capital? 3G Capital. Not many people have heard of it, but thanks to The Economist magazine, I think many more will. 3G Capital is an investment fund. It's Brazilian and American, and they own some of the best brands in the world. It's acquired these brands through acquisitions. You're going to recognize some of the names. They have enough of the stock in these companies that they control what goes on in the companies. Brand names like Budweiser, like Burger King, Tim Hortons, Popeye Kitchen, and of course, Heinz Kraft, or Kraft Heinz, however you want to say it. Only Blackstone has acquired more companies than they have. 3G Capital has acquired companies worth over $480 billion. That's what they pumped into these companies, and the companies have, of course, a larger market cap than that. But that's what 3G Capital has done. And they've been widely admired over the past few years for the way in which they've been buying firms, because they buy well-known firms who are essentially oligopolies. There's very few firms in their industry. The firms have long histories. You know, when you look at Budweiser, which is owned by Anheuser-Busch, Budweiser was founded in 1876. Heinz was founded in 1869. These are companies that have been around for a long time, and they're stable, and they dominate their industries. They're oligopolies. There's only a couple other companies in their industries. And so they have pricing power, and they have very steady sales. They have a very even cash flow. And what 3G Capital has done is they've loaded these companies up with a lot of debt because they have a lot of cash flow. Cash flow is coming out. The cash flow is paying off the debt. And those firms that they've bought, they've loaded them up with $150 billion of extra capital, extra debt. And they've gone into these companies, and they do almost a surgical cost cutting to boost the financial returns. They do what's called zero-based budgeting. So managers in these companies have to justify every single dollar they spend every year. There's no way you can say, we spent this much last year, we'll spend this much this coming year. And they can only reinvest a portion of what they have coming in. Only a portion of the operating profits can be reinvested in the brands. So that the whole focus is they take on a lot of debt. They're using the debt to buy other companies. And of course, then with surgical cost cutting and really squeezing down the cost, keeping steady sales, they improve the earnings, they improve the EBITDA, the earnings before interest and taxes and appreciation. They increase all those so that they can reduce the debt. And, of course, they haven't listened to my program. Had they listened to my program, they might have understood some of the issues that are going on in American industry and worldwide industry as well. Richard Foster of Yale did a study in which he said that companies that were part of the Standard & Poor's 500 in 1920 have had an average life of 70 years. Today, the average life of companies in the Standard & Poor's 500 is 15 years. InnoSight, an independent company, has done a research, and they say that 50% of today's companies are facing creative destruction. So how does all that apply to 3G Capital? Well, they bought these companies that are old, that dominate their industries, that have steady revenues and steady cash flow, squeeze down the costs so that they improve the profitability. And that all sounds wonderful, and it all worked for a while. But Kraft Heinz took a $12.6 billion quarterly loss in the fourth quarter of 2018. M&Bev, who owns Anheuser-Busch and Budweiser, their sales dropped in 2018. Their profits dropped so much in 2018, they cut their dividend to the shareholders. The restaurants at this time, the restaurants like Burger King and Tim Hortons and Popeye's Kitchen, they're doing okay, but the question is for how long? A couple times in the past 11 years, Roger Stilson has been on the program. Roger Stilson is one of the best restaurant operators I know. Runs Mama Stortini's, has a couple restaurants, one in Northgate, one in Puyallup, one in Kent, maybe there's a couple more by now. Roger Stilson has been in the restaurant business a long time, and he says, as generations change, so do the changes in restaurants. You know, Burger King and Popeyes and Tim Hortons were all restaurants that belong to a previous generation. You know, my grandchildren are going to Five Guys and In-N-Out. They don't go to Burger King. They don't go to McDonald's. They're looking for something special. You know, so this idea that 3G Capital had is beginning to cave in. You know, and it's hard to know which companies are going to falter and which won't. You know, this whole idea that 50% of companies are facing creative destruction doesn't mean that all the companies will. Some will adapt. Some will make changes. You know, but there are those that won't make it. Kraft Heinz has been a big success and a successful strategy for most of its life in America. That seems to be coming to an end. People are eating healthier. People are changing their diet. And what we're seeing is a migration to smaller, more specialized foods in the diet. That's had a significant impact on those brands. We're seeing that not just for companies like Kraft and Heinz. We're seeing that across the spectrum of industries. And some of the companies that have been on this program, you've heard about some of the brands that they're competing against. They're special. They're in a niche. And you're going to hear from my guest today, who has another niche, which I think is very interesting, but fits in this whole thing of not being the big dominant brand, but finds a special niche, which appeals to a certain number of people and is taking away from the sales of the big companies. Means something else for investments. It means that the old idea of buy and hold strategy doesn't work anymore. You know, when I started my career, I started cold calling back in 1986. I would call up people and find out what they held, and I'd find out if we could work together. And I can remember calling one prospect, and he started listing the stocks he owned, and they probably had 75 different stocks. And the thought that was running through my mind is, here's a huge stock investor, and that's my specialty, doing stocks. So I went to see him, and I'm thinking and finding out about who he was and what he was doing, and he was probably in his 70s or 80s. He said he'd been buying stocks since the 1930s. And I was asking him, you know, to tell me about it. And what he was saying is, back in that time and through the current time, he was buying 2 or 3 shares of a company. And of course, you buy the right companies and it splits 5 or 10 or 20 times. And suddenly, instead of having 3 shares, you have 200 or 500 shares of a company. You know, he never sold a single stock that he owned. He'd owned some of these companies since the 1930s. You know, that was the last time I met with him. I knew that we weren't compatible with what I do. And that was 1987. That was when companies lasted a long time. That was then. This is now. And what we know is things have changed. Let me ask you this question. What do these companies have in common? Think about this. What do these companies have in common? Alcoa, Anaconda Copper, American Can, American Tobacco, Bethlehem Steel, Chrysler, General Foods, Goodyear, Johns Manville, Owens, Illinois, Swift and Company, Sears, and the Texas Corporation. You've heard of most of those names, right? You know those names. They've been around a long time. You know what they have in common? The same thing they have in common with Union Carbide and U.S. Steel and Westinghouse Electric and Woolworth. Every one of those companies was part of the Dow 30 in 1966, and every single one of them has either been dropped from the Dow or has been forced into bankruptcy and completely dissolved. Every single one of those names that I mentioned, every single one was part of the Dow and is now gone. And do you know what these companies have in common? Microsoft, Intel, Southwest Bell, Home Depot, Apple, Verizon, and Walmart. You know what they have in common? We're coming to a commercial break, and right after the commercial break, I'll tell you what they have in common that you should know. Because we are coming to a commercial break. Don't go away. You want to know what those companies have in common. Right back after the commercial break. Don't go.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So when I left off before the commercial break, I mentioned several companies, Microsoft, Intel, Home Depot, Apple, Verizon, and Walmart. What did they have in common? What do all those companies have in common? Well, I'll tell you what they have in common. Every one of those companies is part of the Dow Jones today, and every one of those companies, not one of those companies, in fact, existed in 1966. The first list of companies I gave you, they were part of the Dow 30 in 1966, and they're either out of the Dow or bankrupt and completely dissolved. These are the new companies. Not one of those new companies existed in 1966. There was a time, like that one prospect who never became a client, there was a time when you could buy and hold, buy a few shares of a stock, stick it in a drawer, and hold it forever. Those times are gone. Yes, I do believe in holding things for years, and I've had one stock in my client portfolio since 1996. That's 23 years. It's been a long time. On the other hand, most companies are only in my portfolio for about a decade, sometimes a lot less. Things I believe in holding for a period of time, not for trading, but I also believe that things are changing very rapidly. And think of what's going on with a lot of the companies. I mean, think of the growth of the companies. Think of Microsoft. From zero sales to $1 billion in sales, it took them 14 years. For eBay and for Facebook, from zero revenues to $1 billion in revenues, it took 7 years. For Zynga, if you haven't heard of Zynga made a thing called, is in the gaming department. They made a thing called Farmville. They make words for friends. They do a poker. They do those sort of things. Zynga went from zero to $1 billion in 4 years. Now, sadly, for Zynga, it reached $1 billion and then it began to fade off. And 4 years later, it was only bringing in $690 million. So, I mean, as fast as they rise, sometimes they can fall. You know, the opposite side is not trading either. Like, late Jack Bogle said best, in his 50 years of experience, over 50 years of experience, he never knew of anyone, nor did he know of anyone who knew someone who had consistently beaten the market by trading. I think when you see those trading models, and I go to shows a couple times a year when I look at the trading models, and they get testimonials of people that have made money. And you do make money. If you invest $100 and you have $105, you're making money. But if the market has gone from 100 to 120, you're not beating the market. You're just making money. And that's what those trading companies do. They'll show you and have testimonials of people making money. But I've never seen in my 33 years any back-tested model or any hypothetical model or any trading system which has consistently beaten the market. So 3G Capital Group was my lead-in. But there's other companies. There's companies in my industry, and I talk about this every so often. I believe we're in a period of creative destruction in my industry. When I started in 1986, it was already beginning to happen. The first wave was hitting. It was the discount brokers. 1975, the commission market or commissions were deregulated, and suddenly springing into business, Charles Schwab started discount brokerage. Big brokerage houses didn't believe there was going to be much to it. Even by 1986, when I got into the business, and it was all a commission model, even when I got into the business in 1986, the big brokerage houses who dominated 93% of the market for full-service brokers kept saying the discounters are going to have a very small portion. They're going to have the poor people. They're going to have the people who can't really afford a stockbroker. Those are the people the discount brokers were going to have. Well, the reality was, by the early 90s, the discount brokers had 1/3 of all the revenues happening in the financial market. That was the first wave. The second wave was a wave that came as the big brokerage houses were being squeezed now by the discount brokers and being squeezed by lower commissions and deregulated commissions. They began to squeeze their own workforces. So if you had a low production in one of the firms, they actually reduced your payout so that if you produced under a certain amount, and I don't remember what it was, they only paid you 25% of your commissions. I was in a higher bracket. I got 40-some% of my commissions. But for small brokers, they were forcing them out. They wanted them out of the business. I can remember going to a conference where they were talking about the average income of an American couple. And the average income was less than those brokers that were being squeezed out were making. But because of the cost, they were getting rid of those brokers. And those brokers were beginning to be re-registered. There's two acts that were passed by Congress: Securities and Exchange Act of 1932 and the Investment Company Act of 1940. I fall under the Investment Company Act of 1940, and those registered representatives of the big brokerage firms where I started fell under the Securities and Exchange Act of 1932. That's where I started as well. That controlled 93% of the market. They were forcing the small guys out. But as the small guys went out, so did some of the rest of us go out. Some of the rest of us started our own businesses. And so what's happened is at this point of that full service brokerage model, about 50% is in with the big brokerage firms and 50% with the registered investment advisors. That's where I am. We have actually exceeded the big brokerage houses. They are losing market share to us. That's what's happened over that period of time. But there's something new that's coming as well. And I've talked about this before. It's the robo-advisor. Now, the robo-advisor gets bad name among the full-service brokerage houses. It gets the name that it's only going to be the small investor who uses the robo-advisor, that individual investors really need hand-holding, and when the market turns down, and this is a week in which the market was down 4 days out of the first 4 days, when that happens, full-service clients need hand-holding. They need to be told it's going to be okay. Pat on the back. Things are going to be fine. Don't worry. Just ride with it, That's the philosophy in the full service brokerage account. That's why you need a financial advisor that takes care of you. The robo-advisors, they only charge 10% of what a full-service broker costs. And a full-service broker, their fees have been already squeezed down. But the robo-advisors charge 10%. And my private banking is a separate company, independent company, that does surveys. And they found that high net worth individuals, those who the full-service brokerage account firms feel belong to them, 46% said that they were aware of robo-advisors, and of that group, 70% were thinking of using a robo-advisor. BlackRock did a study, and they found that their bread and butter client felt that the robo-advisor was going to be more convenient, was going to sound simpler, was not going to have a product push, was going to be lower cost. They were going to have more choices than they had now. They were going to give objective advice, and they were going to rule in the client's best interest. And 18% said that they were going to get better advice from a robo-advisor than a human advisor. Think about that. 18% thought they were going to get better advice. That's happening in my industry. And it's happening very quickly now. Robo-advisors are growing. If you plot the pattern and look at the discount brokers and what they were doing, now we're finding the same thing with the robo-advisors. And what we're finding in my industry as the growth pattern has not been to grow client accounts. What's been the growth pattern is mergers and acquisitions. I have been approached by over 20 firms who want to buy Adams Financial Concepts. And I talked to them. There's 6 that are very, very serious. Not that I'm going anywhere. I'm not going anywhere. But what I'm saying is that's the new growth model in my industry, is to sell your firm to somebody else. That's where things are headed in this industry. 3G Capital is where we started with this whole thing. 3G Capital was a company that bought companies that had been around for a long time, that were stable, that had good revenues and strong cash flow. They're finding out that those companies are beginning to die. Think about the others. Eastman Kodak, remember them? They used to dominate the camera market. Palm, I carry around a phone in my pocket. Remember the Palm the Palm Trio? I mean, all the Palm Pilots, the little stylus. Palm died. BlackBerry came along and offered a keyboard and email. And then, of course, Apple came along. Companies are springing up. Companies are facing creative destruction. It's a time in which you have to be on top of where you're going, or you're going nowhere. You can't just put away a stock and hold it forever. You have to be aware of what's happening within the industries and how that's working. I'm very aware of what's happening in my industry because I live in it. I'm very aware of what is happening in a number of other industries because I spend a good deal of time studying it and knowing what's happening. That's where you need to be. Anyway, that wraps up this portion of the show. I got going and I didn't introduce my guests, so you have to wait until we come back after commercial break to hear what she has to say. And she has a very interesting story to tell. So hang on, I'll be right back, and you want to hear what she has to say.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
Welcome back. I'm here with Nicole Wakely, if I said that right, of Tree Capital. Welcome to the program, Nicole.
Hi, Mike. Thank you for having me. It's a pleasure to be here.
And with an accent like that, it sounds like you did not come from America to begin with.
No, I wasn't born here. I was born on the other side of the pond in London.
Aha. So let's start with your background so people know your background, and we'll get to Tree Capital as we go.
Thank you. So I started my professional career as an attorney in London. I loved the intricacy of detail. My cases consumed me. I worked many hours, nearly got lost in it, and then woke up one day and said, I want to go to Hong Kong.
Hong Kong.
Yep.
Enough of Temple Square.
Yes.
And off to
That's it. Off to see some real temples in Hong Kong. Now, once you've seen one temple, some people say you've seen them all, but that was not the case. Hong Kong inspired me. I felt an inner drive to just travel the world, to soak up different cultures and to learn. And one of the things that I did learn there was that I could step back and remember what was my dream.
And so what was your dream?
My dream was when I was a 4-year-old little girl, and my parents used to say to me, so, Nicole, what do you want to be when you grow up? And I would think, Mummy, I want to have a furniture shop. I want to have an antique shop and a little cafe, just like our village in Farnborough, Kent. She was like, really, darling? And I know she had aspirations way beyond that.
But you wanted that.
I did. And so while I had been very blessed to be successful as an attorney, even, for example, being named in the Legal 500 as one of the youngest and smartest, apparently at the time, attorneys there, I just wanted to apply my mind and my detail and my searching for something that made a difference to my life and to others. And I had this opportunity when I met my husband in Hong Kong, and he said to me, what is it that you want to do? And I remembered this dream from when I was 4 years old. And he said, well, go on, darling, you better do it. So as a leap of faith, I did, and I followed my head and my heart, and I opened a company called Tree. And the name Tree came to me because it represented sustainability. It represented a dream I had of being a child swinging on a swing under a tree. It represented life. It represented sustainability. And Tree to me is exactly that. It's the beauty of an ongoing tree. But what we do is we offer furniture that I've either designed or sourced from sustainable backgrounds, offering them here in the US.
So, yeah. So tell us about the furniture itself.
Okay. So it's special. It's unique. It's what I call eco chic. So each individual piece is made by hand using sustainable materials. So whether that is reclaimed teak from old buildings, old boats, or whether it is, even in some cases, recycled paper that then has been crafted into a weave using the old Lloyd loom 1800 weave to look like rattan. So each piece is unique in the sense that it tells its own story of where it's been sourced from, but it's made today by hand with love, especially for you.
So it's not something that's produced on a production line.
It's not mass produced.
Every single piece is individual and crafted.
That's right.
So we started you off in Hong Kong, but you're not in Hong Kong now. You're in Seattle. So tell us a little bit more to your background. How did you get from Hong Kong to Seattle? There was a stop in the...
Yes, there's a few chapters, but I'll try and put them in the right order and as succinctly as I can. So from Hong Kong, as I say, I met my husband there. I started Tree. We wanted to have a family as well as my baby Tree. And so with that in mind, I wanted to bring them up in the fresh air. So my 2 children were born in Hong Kong, and we decided to swing the pendulum as far as we possibly could and move to a farm in Australia where I homeschooled them, relearning all the things that I didn't know. I'd never seen vegetables growing in the garden, and there all of a sudden I was getting down and dirty planting them myself. but I was also experiencing life in a different way and beginning to understand what sustainability means. So that gave me an opportunity to rethink my practices in my business, in tree, in terms of the real strength as to what sustainability means. On my farm, I planted my own trees. I planted 70 trees in our orchard there with my children. I watched their roots grow, I watched their trunks grow, I watched their branches grow, and I understood the true meaning of a tree, that you need to have the balance in the roots to be able to sustain the growth. And that's what I now apply to Tree, my company. So while I was on the farm, I was lucky enough to have my best friend from Hong Kong move across from Body Shop. She was the right-hand lady to Anita Roddick at Body Shop. She did all of the sourcing for Body Shop. And while at Tree, I had kind of run it from my head and heart. She came across from Body Shop with amazing sense of wisdom and knowledge and experience. And the two of us together grew Tree to such a level that I was able to share to sell my majority share, and for us to list it on the GEM Stock Exchange in Hong Kong, from which I was able to take those funds and come across here to a neck of the woods where our philosophy resonates so nicely with the green mindset, with the green outdoors, with the striving for unique pieces and people's sense of wanting something more, something different here.
Yes, in America.
Here in America.
Yes. And it is. It's unique. It's clever. It is when you own a piece of your furniture, it is yours and you know you won't see it anywhere else. So do you have a showroom?
Yes. Yes.
Tell us about the showroom.
Thank you. Yes, I'm blessed to have 3 showrooms now, but our heart is in Tacoma. The reason being that our heart is in a heritage building there. It was a 1910 power substation. So 55-foot ceilings, incredible glass windows, just a sense of power, actually, given that it was a power station. When you walk in, it really is this overall feeling of power and love and kind of modern nostalgia.
And you have 2 others as well.
Yes, we do. We have one in Bellevue, not far from here, in the design market there, just next door to Whole Foods. So, you know, the mindset of those that are going for the more organic food, the hope and the resonances that they will, or you will apply the same approach in how you furnish your home, something beautiful from the inside out.
And besides Bellevue and Tacoma?
So our 3rd little boutique is in Point Ruston, and we're there to service many of our home styling clients because there's a beautiful development there of many condominiums on the waterfront. It's a beautiful place to go. It's fun.
So take us through a tour on the radio of your showroom in Tacoma.
So
tell us what we would see.
Yes. As you walk up the stairs in our showroom in Tacoma, you go to a little landing, you turn around, you got 10 stairs, and as you stand at the top there, you're likely to go, oh my goodness. You just look around and you're lost in this sense of past and presence. As I say earlier on, the ceilings are 55 foot high. There's this sense of just time standing still, but there's also this overwhelming sense of beauty. Beauty because of the building, and as you walk around, there'll be sofas that are made from organic fabrics. There'll be one-off antiques. There'll be excited designers who will just be bursting from their skins wanting to talk to you and help you. There'll be clients going, oh my goodness, I love this. And you will find yourself, I guarantee, touching the pieces and saying, I love this.
That's awesome. So tell us how to find you.
Okay. The starting point is our website, which is tree.co. I always have to laugh. That's not a typo. That's tree.co. We're also, of course, on Instagram as we're becoming more and more social. But then the real place is to come to our heart, to our gallery in Tacoma. We're on C Street in Tacoma, which is downtown Tacoma near the Dome. And otherwise, of course, Bellevue Design Market, as I said, just next door to Whole Foods. And we would love to see you soon. It would be our absolute pleasure.
So can people reach you by email?
Yes. So by email, it would be hello, so HELLO @tree.co.
And the website is tree.co.
Tree.co. That's not a typo. It's tree.co. Thank you,
That's
Mike.
awesome. It's a very, very special, unique business and a great business model, but it represents something that we're seeing across a broad spectrum of industries. It's well worth going to visit and see, so please do. I know that my wife will. Anyway, so thanks for being on the program, Nicole.
Thank you for having me. It's great to see you.
So we're coming up to a commercial break. Don't go away, because I want to talk about something that I started talking about on May 21st, 2010. Don't go away. I think this is important. I think this gives you some insight on where the markets are headed. I'll be right back after this commercial break. And you can always find me in my office at Adams Financial Concepts. Don't go away. We'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm going to talk about something that I've been talking about now for almost 10 years. I will come back to that. First, I would be remiss if I didn't mention the Money Show. It's coming to Seattle, June 15th and 16th. I've been asked to do 3 workshops. And what is it? It's a gathering of leading economists, renowned market strategists, top performing portfolio managers. Steve Forbes of Forbes magazine will be there. Ralph Akambora may be his last time to appear at the Money Show. The Money Show has been going for several decades. It may be his last appearance. Bruce Johnstone, the president of Fidelity, will be there. Larry Kudlow, who's in charge of the President's Council of Economic Advisors, will be there. Edward Yardeni, who I think is one of the top economists in the country. Louis Navalier, who is well recognized. And Mike Adams is going to be there too. I don't show up on the front page, but I guess that's okay. It's free because the way it's paid for is by exhibitors. And yes, I do have an exhibit, and so does KLFE has an exhibit. Fidelity has an exhibit. A lot of trading stations have exhibits. A number of people have exhibits, and even the marijuana growers have exhibits there. And there's a lot of interest in that. Whether it goes up in smoke or not, we'll have to see. But that's, it may be something that is very strong medically. Anyway, I can't make really good jokes. It's a big honor for me to be talking and being asked to talk. And of course, I am underwriting part of it. It draws at other places about 4,000 to 5,000 people. Seattle, they expect for it to draw 2,000. It's completely free. Go register for it. Sign up for my workshops. I'm doing 3. I'm doing 2 on profit sharing accounts. That's the new offering that I have, which there's no fee, there's no cost, except we share profits, 20, 80%. Very good concept, because if you lose money, I don't make anything. There's a focus on making money, and I'm fairly moderate in my approach. But I do believe that I can combine both a superior performance and lower risk doing that. The way it's set up, you have to come see. It's really, I think, very unique within the industry, very unique with what is being done out there. Those are 2 of the workshops I do. The 3rd workshop is, how will this all end? And if you've been listening to this radio program, it's not going to be a surprise to you. How does this bull market end? And I don't believe it's going to end for a number of years yet. But I'll be talking about what I think and where it ends. And I haven't decided yet. I will be doing a speaking engagement on the floor of the exhibit hall. I don't know what exactly I'm going to do yet. I'll have to figure that out in the next few weeks because it's coming soon. So, you know that I believe that history doesn't repeat, but that it rhymes. There's lessons to be learned from previous markets and looking at previous markets. I first started talking about Dow 100,000 back in May of 2010. At that time, the first radio program I did, the Dow stood at 10,193. It would come from 6,600 to 10,193, and Dow 100,000 seemed like a long way away. That's 10-fold increase. So I started talking about the times it had happened before, because in 1941, the Dow was 100. By 1949, it had grown to 200. Of course, we'd gone through the World War II. We'd gone through a number of problems. We had people coming back. And during that time, it grew from 100 to 1966, 1,000. Now, during that time, you had a lot of housing going on. You had the return of the World War II vets. You had education going on. And disposable income was increasing significantly. So was debt. And you were beginning to see women enter the workforce. Prior to that time, most of the women were stay-at-home moms. Beginning after the World War II, we began to see women enter the workforce in significant numbers. But in 1966, the market reached a peak at 999 point something, and then it began to drop down, and it dropped down 20%. By late 1968, however, it had risen back to 1,000. And then in the last couple months of 1968, it began to fade. And by mid-1970, it was down 30%. And there was another rally then, beginning in mid-1970, that took the Dow back up to 1,000 in 1972. And then the market rolled over, and by mid-74, it was down 40%. And in early 75, the market was coming back and hit again 1,000. And then rolled over, and by 1978, it was back to 780. Going into 79, 70, 790. And then something happened. The market began to climb in 1982. As the market got close to 1,000, people were saying, we've been here before. We've been here before. Every time we've been here before, it's dropped. It dropped 20%, 30%, 40%, and 20%. So 4 times we've been here before, and every time it's dropped. You had some of the great gurus of market shorting that came out and said, now is the time to short. They lost all their shorts. They got creamed because the Dow started from 1,000 in August of 1982 and would climb over 10-fold. The Dow, I remember talking to a client when the Dow was over 1,700. He was waiting for it to drop to 1,300. I never called him back after that because he was adamant that the Dow was going to be 1,300. You know, in 1987, the market crashed down. It never got to 1,300. It moved up by by March of 2000, it was over 11,000. That market in 1966 hit 1,000. By 1982, it was at 1,000. By March of 2000, it had grown to over 11,000. And then we had a similar time period. You know it. We had the dot-com come along. We had that whole period of time from March of 2000 until 2010, when the market just hung down. And you could have gone away on a vacation for 10 years, come back and thought that the market hadn't moved at all. But what's happened is the market has moved. Today, it's sitting at around 26,000. I would be surprised if we aren't very close to 30,000 by the end of this year, maybe above 30,000 by the end of this year or early next year. You know, I predicted that we're going to have a very good year this year, and maybe it'll roll into next year. But if you look at the price earnings ratio of the Standard & Poor's stocks, traditionally they've run between 18 and 21, 18 and 22, and beginning this year, they were under 15. The stock market is driven by earnings, and so if the earnings really count, one of two things has to happen. Either companies have to have a very bad year and we have to see a recession, or we have to see a stock market that really moves up. I'm believing it's going to be the second one. Come hear me at the Money Show, and we'll talk more about this. And until then, go register for the Money Show. Go check any of my podcasts. They're on YouTube. They're on my website. Check us out and see what we have to say. Have a very good rest of the weekend, and I will be back next Saturday to talk about money. Till then.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.